Okay, my name is Prasitus Derajat. So what I was catch up from previous week is just talking about case study, especially Zuber Inc. case study and calculate forex exchange rate. But now I just talking about executive summary from Zuber Inc. case study. So Zuber Inc. is multinational company that based in US and they having interest to invest in Eastern Europe, especially in Poland, following lifting of Iron Curtain in 1989. And Poland monetary policy shift is currency value market determined from common driven under the Soviet Union, and another shift is allowing foreign investment. For the spot rate in 40 Polish zloty, and the interest rate on a year security in Poland is 14%, but in USA is 9%. So for the local bank created a forward market for zloty following the privatizations, and the bank quoted a 1 year forward market rate is 39 zloty. For the group is in the company international money market divisions, and they have $10 million over the next year, and they have to assess the possibility of investing short-term fund in Poland. And for the objective is to earn the highest return possible while maintaining safety. In this case study, there has 4 questions. For the first question is, would you be willing to invest in fund in Poland without covering the positions? Well, the answer is it appears to that it is profitable because the yield offer is 14% in Poland as compared to only 9% in the US. However, the error is the country currency has just become market determined, so it's volatile, and the zloty is yet to find equilibrium price, and of course probability of high inflation as the interest rate is high for a stable economy. So the second question is suggest how you could then cover interest arbitrage. What is the expect return from using covered interest arbitrage? For the covered interest arbitrage would involve exchanging dollars into zloty today, then investing the zloty into Poland treasury securities, and negotiating a forward contract to sell the zloty in 1 year in exchange for the dollar. Given that $10 million is available, this amount would be converted into 20 million zloty, which would accumulate to 28.5 million zloty. And for the next question is, what risks are involved in using covered interest arbitrage here? The bank may not fulfill its obligations on the forward contract, and the government could restrict fund from being converted into dollar. So since the country has only allowed foreign investment recent, it does not have a track record. There is some uncertainty about its future laws on international finance. And the last question is, if you had to choose between investing your fund in US Treasury bills at 9% or using covered interest arbitrage, what would be your choice? Defend your answer. And having calculated the return of the covered interest arbitrage and profit of 11.15%, and the return in case of investing in US, the profit of 9%. So it turned out that the Eastern Europe countries market has a greater potential than the US market when it comes to profiting from interest. That's it. I think I just bring about the case study Zubering. Thank you.